Hello, my name is Ryan Herman. I'm the editor of CA Magazine. Welcome to the latest in our series of webinars in conjunction with Xero. In the previous webinars, we focused on MTD for ITSA, which was originally meant to be coming into effect in April 2024. But in December last year, it was announced the date will be pushed back 2 years to April 2026. Thankfully, that's given everyone some breathing space, although it doesn't mean firms and bookkeepers can put that to one side for a year or so. And there are other issues coming down the road as well. And today we're going to focus on basis period reform as well as companies' house reforms. And together they will ensure that you'll have enough on your plate over the next 12 months, as well as gearing up for MTD. Now, the person doing virtually all the talking today is Sam C. He is education specialist at Xero. Sam has worked in finance teams across various industries. He joined Xero 5 years ago when he became accounting specialist, focusing on customer experience, before moving into his current role last year. And he regularly does demos for accountants and bookkeepers, so he is an absolute expert on all these issues. Sam will talk through the agenda for today and explain in more detail about these reforms, along with how software can help build practice resilience in the face of what probably feels like constant and never-ending change. But following his presentation, there will also be a chance to put your questions to Sam, which we thoroughly encourage you to do. Take that opportunity to tap into his vast pool of knowledge on these reforms, as well as all things MTD. So without further ado, over to you, Sam.
Excellent. Thanks so much for that introduction there, Ryan. And it really is a pleasure to be able to come along to a session like this and just chat to the people attending. That was a very, very flattering introduction there, with throwing out words like expert and expertise. And I certainly hope that I'll be able to live up to that, especially when it comes down to some of these updates in the legislation. So just like Ryan said, that I am an education specialist here at Xero, which means predominantly what my time is spent doing is I actually have the privilege of chatting to, teaching and helping a lot of our accountants, bookkeepers and partners make the most out of Xero and the product. But what that also means is I often end up delivering content on our tax product and the latest legislation, just like what we're hopefully going to be looking at today. And because of that, it does mean we sometimes get these insider looks at what perhaps is going on in the industry. So I do hope I will be able to go ahead and live up to those expectations there, Ryan. What I am going to do is I am going to go through a presentation and talk quite a lot about the topic of basis periods and basis period reforms. So just first, I am going to shut off my camera and I'm going to share my screen just so that we can really enjoy what we're looking at more than just staring at me talking. So again, I do just want to say there, thanks for allowing me to come along, and thank you for joining me for this session. Prepare your practice for basis period reform, companies house reform, and the upcoming regulatory changes. So like I said, at Xero, we do our best to keep an eye on what's going on in the world of HMRC and companies house, and we try to make sure that we understand what our accountants and bookkeepers are going to be facing as well. And so with basis period reform coming soon, as well as that companies house reform, there's going to be plenty of change to try and get your head around for the next few months. Now, I'm about to go through the agenda for what I'm going to be talking about, but what I'd love to do is just very quickly, while I'm talking about the agenda, is I'd just love to launch a quick poll and get your kind of feelings around basis period reform generally. So that should have popped up on the screen there for you. And of course, that poll we're looking at, it's just generally, how confident are you to discuss basis period reform with your clients? It's got not at all, need to understand more. I understand the basic implications. I'm fairly confident with what's coming and what I need to advise. And I feel confident and ready to start having those conversations. And so just while I give some time to go through that poll there, I'm going to just go through, talk about the agenda a little bit. So today I'm going to go through and we'll get an overview of those upcoming changes, discuss how perhaps software can help build resilience in the face of constant change. I'll start off by talking about basis periods and the upcoming basis period reform. Then I'll talk about how you might begin to prepare your practice for this change. I'll then briefly talk about Companies House reform, and then on to how Xero or even other softwares can support you as accountants and bookkeepers and help make a practice more resilient in the face of legislative change. So at that point, I think that's a pretty good point to round up that poll. So if you haven't voted, please do try and get that vote in, but I think we'll just call an end to the poll there, and we can maybe chat a bit about some of those results. So it looks like there is a huge majority in the fact that most people are borderline not too sure, but there's a huge majority of 71% of the attendees there saying they understand the basic implications. Fantastic. That's always a great foundation to start from. So I'm just going to, hopefully throughout this session, go through and really strengthen some of that knowledge in the background there. So we've been speaking about making tax digital year after year, looking at the delays. And for example, MTD for ITSA was supposed to be next April, but has been delayed to 2026, and then even the stage after that, 2027. But in the background has always been that basis period reform. And so, of course, while MTD has been delayed, basis period reform hasn't been. So we'd been preparing for that next step of MTD for 2024, the big bang of digital record keeping, and hopefully having those benefits for ourselves and clients alike. But luckily for some, I say for some, that was delayed. Now, basis period reform, however, is still coming into play from April 2024. And so what does that mean in practice? So basis period reform will change the window of time that income tax is calculated. In short, we'll use the tax year instead of a business's accounting year as that basis period. But then before we get into those details, let's just take a short moment to get clear on what we might mean by basis periods and accounting periods. So the basis period refers to the period of time used to calculate those profits and the income tax for a business. Whereas under the current rules, that income tax is calculated on the profits earned during a business's accounting period. Generally, businesses work out their accounts using the same year-end date, their accounting date each year. But so, for example, if a business has an accounting year-end date of the 31st of October, their taxable profits will be calculated from the 1st of November 2021 to the year-end date of the 31st of October 2022 for that 22-23 tax year. We all understand that that's a lovely simple thing. But the big change there is that from the 24-25 tax year, HMRC's basis period reform means all unincorporated businesses will be using the UK tax year of the 6th of April to the 5th of April as their basis period for income tax. The accounting, so what's the big difference there? And that, again, a couple of these questions might seem like we're treading the same ground and they might seem relatively simple. But in order to make sure that we can really build up on this, we have to be able to strip back to those absolute foundations and really understand it. Because how are we supposed to support our clients if we don't understand? So the accounting period, of course, is then chosen by a business and is used to produce those financial reports. For example, preparing the financial statements for investors or auditors to that example year end of the 31st of October. A business's basis period is that window of time HMRC uses to calculate their income tax liability, as well as, of course, for those wider tax purposes. Accounting periods and basis periods are often the same for most businesses, but some do differ. So, for example, if a business was set up in the middle of that tax year, the accounting period could run from the 1st of June to the 31st of May. And we all already know that those non-coterminous basis periods and accounting year ends can make preparing the accounts a trickier job. So currently, unincorporated businesses are assessed for that income tax based on the profits made during their accounting year. Going forward, these businesses will be assessed for the income tax based on the UK tax year. That's 6th of April to the 5th of April. This change is coming into place for that 24-25 tax year, with some transitional rules applying in the 23-24 tax year. From that 24-25 tax year, a business's income tax liability will be calculated based on their profit or loss during the UK tax year instead of that accounting period. Now, businesses can still use different accounting dates that don't align with the tax year. They can still have those non-coterminous year ends. But that does mean they will then need to make those apportionment calculations each year when calculating their taxable profits. Now, this change will affect unincorporated businesses such as those self-employed traders, including the individuals with a profession or a job, those partners in trading partnerships, including those LLPs, the limited liability partnerships, the other unincorporated entities with that trading income, like those trusts, those estates, and also the non-resident companies with a trading income charged to income tax. So let's add a couple stats to that, because we're all accountants and bookkeepers here. We all love stats. Honestly, it's half the reason I ended up getting into it. Love a bit of the spreadsheets, and I love my stats. And this is going to impact only around 7% of sole traders, but a massive 33% of partnerships. And I did say only there for those 7% of the sole traders, but let's not let those stats fool us. This is going to have a huge impact on both the work and the conversations you'll have with clients. So thinking about some of those impacts that it might end up having. The first effect is that those businesses will have to calculate their tax across a different period, which actually will likely mean that will likely result in your clients wanting to perhaps update their accounting period to match the new basis period. And of course, as you'd expect with any legislative change, you'll also see an increase in the amount of client admin you have to do. Any business who doesn't have that 31st of March or the 5th of April year end will eventually receive a letter from HMRC suggesting they might want to change their accounting period date. And now I do, of course, mention that they will receive that letter, but to further add to that point, we have currently no idea when those letters are going to be sent out. We just know that they're going to get sent. Which then, of course, means that that puts quite a big burden on your shoulders as accountants and bookkeepers to start communicating some of this information to your clients before HMRC even send those letters. And then that, of course, could then prompt your clients to ask about changing their basis period. And now, if they haven't done that yet, we'd really suggest a proactive approach from you now to try and get ahead of that curve. You then need to also consider both the effort and the expertise required to calculate the tax across those transitional periods, because there will be a lot of clients wishing to change their accountancy periods, and they'll end up being met with these longer or shorter tax periods throughout that transition, which then unfortunately falls to you as accountants and bookkeepers to figure that out. Just to think of an example there. So let's say I have a client who has a 31st of December year end. The client might approach me and say, I'd like to change my accounting end dates to the 5th of April. What do I do? So that client will have a 15-month period at the start of that transitional year. And there will be plenty of other examples. I'm sure you can even probably think of a few off the top of your head now if you've begun to look into this, where you'll have clients that have the extended periods where the profits need to be calculated. So we could be looking at anything from that 13, 14, 15, even 16 months worth of profits, which for that transitional period will mean increased tax bills for our clients. And then because of those increased bills, that might then impact their ability to claim certain benefits. It might kick them up into the increased child benefit allowance, or decreased as they increase. And something else is the national insurance might be something else to consider, as well as all the other things that are threshold and turnover based. And if your client then has a basis period that doesn't align to the tax year, and they don't want to change it, you'll need to apportion the transactions to ensure they're reporting on a tax year basis in line with that basis period reform. So let's think about an example here. If our client has a year end of that 30th of April and they don't want to change their basis period, this means we'll effectively be preparing an 11-month period covering the 1st of May to the 5th of April. And then on top of that, a 1-month period covering the 6th of April to the 30th of April. We'd then be combining that 11-month period from that year with 1-month period from the previous year to calculate the accounts for that tax year. Which means we're actually having to do 2 adjusted profit computations and add them together if we don't align with that tax year, with the non-coterminous year end. And it's not quite doubling the work, but it's getting pretty close. Another example is, let's say we have a different client who has that year end of December. If they choose not to change their basis period, it's highly likely that the accounts won't be completed before the tax filing deadline, resulting in estimated figures being submitted each year. Which then leads us into all sorts of issues as to whether you put provisional figures in, go back and revise all of these figures, which then starts to tie us in knots. And it actually means even more work and client communication, because we're submitting an estimate, we're then having to go and amend that to enter in the revised figures once we have that information. And it totally changes the dynamic of what we're used to submitting. And that's just huge from an admin standpoint. So thinking about what we can begin to do to prepare here. Now, this is a topic we have all talked about time and time and time again as we travel through MTD and the digitalization of accounting and bookkeeping. We've seen it. There have been so many years now. We've been working through these changes, these legislative changes, these updates, and the digitalization of accounting for well over 5 years now. Longer than that, in fact. So we know certain ways to prepare. We've looked at it before. But there are a few things to consider about basis period reform that are going to be a little bit different to everything else we've looked at before. The biggest and most important step to take is communicating with not just your clients, but your staff too. There's no point in speaking to your clients if your staff don't know about basis period reform yet either. You'll then, of course, as part of that, need to consider preparing your tax teams for these changes internally. Do these teams have the capacity to take on more load, to work closer with the clients, to deal with those transitional periods? And more importantly, how are your tax team upskilling to know what these additional transitional profits are impacting or what they're not impacting? So there's room for this huge education piece internally, not just to your clients. Because this process is confusing enough to us as trained professionals, let alone those small business owners who absolutely will be coming to you almost in a panic, trying to understand it. So it's important to begin having these conversations with those clients, especially if you haven't begun so already. And now, these conversations are actually especially worthwhile. And that's because we aren't able to segment clients in quite the same way as we have before. So, of course, when we looked at things like MTD for ITSA, MTD for VAT, we were able to quite rigidly segment our clients to understand what they needed. Well, we aren't going to be able to do that same kind of granular segmentation. We are still going to be able to split our clients up. We'll still be able to segment by perhaps business structure, and then even then use that to form some of those smaller target groups. But the key thing there is we need to appreciate the client's individual journey. Because basis period reform is going to cause changes to your client's accounting that will be completely different for each and every one of them. It's going to have to be tailored to what your client actually needs. A final consideration there, and this is one that I know a lot of people don't always like to talk about. It's one that we especially don't like to talk about with clients when when it feels like we're imposing the changes on them, but we're not. It's come down as legislative change. And that's to consider about how your relationship with the client and your billing structure is going to change. There will be additional calculations and additional work required from you. If your client decides to change tax year, you'll need to deal with the transitional year. If they decide not to, there's going to be extra work each year, perhaps multiple times a year going forwards, to work out those overlaps, the overlap profits, the reliefs, even amending those previously submitted accounts. There's going to be so much more admin and client management for us to do here. So one of the things to think about there is, are you going to bill this additionally, or are you going to end up trying to absorb it as part of your annual tax return costs? It's really important to begin to think about that. And then the very last thing there is, of course, be proactive with your approaches to the changes. Which then leads us on to begin to think about some of those conversations that we can have with our clients. So let's just think about a few of those things that you could do as part of those conversations. Of course, the big one to think about is those clients that are unaffected, let them know. Let them know that basis period won't impact them. That will settle their minds. I mean, they won't phone you in a panic closer to the time. Especially means they won't phone you and say, I've never received my brown envelope from HMRC. What's going on? You could be like, don't worry. It's not affecting you. Something else that we've seen, and this is a few of these examples are fantastic bits of advice and tips we've seen from some of our accounting partners here at Xero. So one of the examples we were given by one of our accounting partners was they began to put scenarios together to show the pros and cons of changing the year ends. They explicitly did that list and then spoke to their clients and said, what are you trying to achieve by changing the year end? What's the commercial gain here? Is there going to be a substantial benefit from changing the year end to match in with basis periods? Are you going to have to adapt how they're doing some of their bookkeeping? And throughout creating those scenarios, it meant that the partners that have been having these conversations early have already been able to start to alleviate some of that stress and even work on these changes ahead of time. It's important to let your clients know if they might be affected by some of these additional profits for those extended periods. Will they be pushed temporarily into those higher tax brackets for those extended periods? And another one we've seen is offering face-to-face conversations to then sit there and discuss those projections together. because that then can drastically improve those relationships, as well as what your client understands and what they want to achieve. The key will be giving your clients the information to make the decision themselves. And again, we've touched on a few things that we don't always often want to talk about there. And we can actually see this as a little bit of an opportunity. There's that opportunity to gain new clients as well. There are going to be businesses out there that are not represented who might fall foul to some of these changes. And those are the businesses that are going to be looking for support from an accountant and bookkeeper more than anyone. And then you have those existing clients. They're going to be leaning on you as accountants and bookkeepers even more to try and navigate these changes. So it can really be a fantastic opportunity to win new businesses, grow your portfolio, all the while deepening some of those existing client relationships. Now, I'm just going to briefly touch on this one here because we don't actually have a huge amount of information presented to us yet. And that's just to talk about Companies House reform. So this is something that has been mentioned by Companies House here, and that's where those smaller micro entity accounts and those company accounts will be required to include a profit and loss as part of their account submission. Of course, at the moment, we know that those micro entities only need to submit that basic balance sheet with the minimal additional information to Companies House. But this is something that Companies House have mentioned, and it's definitely worth looking out for in the economic crime bill as to when they're going to start actually implementing this. But something else that they've mentioned there is that Company House are going to be closing their web filing service and decoupling from Cato, which means that software will be needed for those submissions going forward. Now, we don't have a date, but I really would recommend keeping an eye on that crime bill to see when it comes through. And of course, if you then haven't started considering options for software providers, now's the perfect opportunity to start. So we've then seen here at Xero, so many of our accounting partners have begun to embrace these changes and use them as an opportunity to modernize their practices, all the while taking steps to ensure resilience and preparedness against those future changes. An example we've been given recently and that we've seen is the active use of portals for both clients to upload and download the information and documents from, but also the practices have been using them for that real-time data sharing solution, utilizing those portals to make sure that everyone has access to what they need to when they need it. And here at Xero, we've also made huge strides in providing the support and tools. So there are an absolute mountain of ways to store information within the Xero platform. We've also got our fantastic partner program, HubDoc, that allows your clients to feed all of their information directly into Xero from either their emails or even on the go with their phones. But we also have our fantastic Xero Tax platform, which then includes the company and sole trader accounts production. So within Xero Tax, you can file FRS 105 and 1021A for micro and small companies, respectively. We've also got our sole trader accounts production along with our personal tax self-assessment portal. And this puts us in a really strong position to be prepared for any closure or changes in these legislations. By having these, or at least a similar digital record-keeping tool in place, it means it will be so much easier to be reactive and even in some instances be proactive in the face of certain changes. And in this case, especially if we don't have the aligned year ends for basis period reform. Our UK tax team are looking at ways to make sure it's a nice, seamless transition, even if your clients want to change their year end and end up with that extended period or shortened. Or alternatively, we can, or how we can make it more simplistic for those users if we have an accounting and tax year-end period that don't end, those non-coterminous year ends. And then, of course, Xero has that massive ecosystem of app partners to work with to help alleviate some of those burdens at year end for accountants and bookkeepers. Now, just before we jump into the questions, so please do, if you've got any questions, to pop into that Q&A. I'd really recommend just hovering your mouse down to see that Q&A box and popping those questions in. And I will do my best to answer those. I will preface that there are some questions that I might not be able to answer because they might lean into explicit advice, which is something that I'm not able to give on a session like this. But get those questions in and we'll have a look at them. But just before we do that, to just offer some next steps. The first one is make sure your tax teams are ready. Make sure they're aware of the potential for increased tax liabilities. Make sure they're ready to calculate those figures in the transitional years. Start having those conversations with your clients now. Each one will be different. And see this as an opportunity to connect and talk to your clients and maybe even get some new clients. So with that out of the way, I just want to say a massive thank you for coming along and letting me go through that session. And let's get on to some of these questions. So let's just open up my video again, and we'll start trying to have a read of some of these questions there. So let's have a read. So I can see there's a couple questions that are in the box already. And if you just bear with me a moment while I take a read of them, hope that's all right. Okay, so there's a couple very good questions that have popped into the box there from James. And the first one is where James has mentioned that they're more focused on the impact of partners in a partnership. So, for example, for those partners that were made partner from the 1st of May 23, are they allowed to spread their are their profits treated as transitional or standard? There hasn't been any obvious guidance. So unfortunately with that one, like you say there, James, there hasn't actually been huge amounts of guidance in how we're going to treat the partners that have become that have been made partner partway through the year. That is something that we're going to have to keep an eye on and perhaps actually reach out directly to HMRC when it gets closer to the time to try and understand a little bit more about what these implications are. This is something where it's one of those examples where, as accountants and bookkeepers, we are having to be quite proactive and actually ask these questions in advance, because we're probably not going to get too much of this guidance made quite widely available early on as we're preparing for this. These are going to have to be questions that we ask slightly more directly. So I am sorry that I can't answer that. That was a bit of a waffle response, but in much the same way that you haven't seen some of those obvious examples, we're going to have to look into asking HMRC more directly on moments like that. That's your second question there, which is in terms of the timing of paying tax on the transitional profits, should this be factored into the POAs? So very good question there. What I might have to do on that one there, James, is if I get Ryan or somebody to grab that question and perhaps provide Xero with your email address if you were willing, we could have a think about that one and come back, because that one's actually stumped me a bit there. I don't think I can answer that off the top of my head. So perhaps if you were willing to have another conversation another time, we might be able to chat more about that and get you a better and actually get you a response there. Got one or two other questions that have popped through that seem to have a relatively similar theme here. So one of the ones that just before I get on to some of those questions there is, it's just really something that I want to just pick up on off the back of that poll we launched, which I'd absolutely appreciate everyone for jumping in and answering there. And so it's pretty great to see that there was at least a small percentage of users attendees there who do feel confident. But it's not entirely surprising to see that the majority there were people who understand the basic implications but aren't quite onto running up at full speed. And it's really, of course, I've said so many times in this session that one of the most important things is to start having those conversations with clients. But it can be really difficult to have those conversations if we're not quite sure of that strategy. So something that I think I can really, I guess, recommend there is, while HMRC haven't given too many really specific examples, there are a good few education pieces out there from both software providers and even the accounting bodies that have begun to look into some of these pieces. So it's definitely worth reading a few of those different articles from outlets out there and starting to perhaps think about those internal practice processes that we're going to be looking at. And one of the questions there that has then popped up that I can see is it's just how are Xero, for example, or how are our partners as well communicating some of those changes to clients? Because, and I think that's a really fantastic question there, because I can really understand I can really understand why some of those communications can be quite difficult. So something we've seen from some of our partners that are getting a little bit ahead of the curve there is they've been actively working with their clients so far ahead of time. They're not waiting for HMRC to send out those letters. They're doing this really proactively. And something that we've then been doing at Xero is we've been trying to increase some of the conversations around basis period reform for a while. So we've actually been doing it for sending out communications for even up to the last 6 months. But something we've been doing is we've been exclusively communicating with our accountants and bookkeepers, our partners, rather than those small business owners. Because at the moment, this is something that, unfortunately, that burden does fall to those accountants and bookkeepers, because that's when the majority of the knowledge is going to sit. That's where that expertise is actually going to be filtered down from. Because as accountants and bookkeepers, you are the ones who are going to be bearing the brunt of this. So that's where at Xero, for example, we've been doing a lot of our communication to accountants and bookkeepers exclusively. And something we do is we obviously want to try and support accountants and bookkeepers through that, which is why we're partnering with so many different places and for like webinars such as this. And that looks like actually there aren't too many questions left that relate to other things there. So if I can perhaps just, while we wait for maybe one or two more questions to pop through, is if I instead just briefly talk about something that we've thought about a little bit here at Xero, and that's about how software has really begun to play that role in helping practices adapt and work around these regulatory changes. And something that I think is worth talking about there specifically is about how cloud software very specifically provides those real advantages in that real-time communication. So I don't know how many people perhaps on this session have used Xero before, but it allows a totally real-time, even simultaneous use of data from your client and you as an accountant and or bookkeeper, which is so vastly different to those things like that we used to see as Excel. And then things that we're trying to do within Xero as well is building updates to our Xero tax module, making it more seamless to change the year-end process. And then with, of course, Companies House reform, we already have those direct filing of the statutory accounts within Xero Tax. So this really now, as we look into the future of digitalization and perhaps building on the resilience of our practices, now's the perfect time to really look at what software is out there and how they can begin to support you as accountants and bookkeepers within your practice. So I do think that then takes us to the end of the questions, and that might actually a little bit ahead of time, but I think that's a pretty perfect time to since we're at the end of the questions, for me to just say thank you so much for coming along. Thank you so much for allowing me to take your time and speak about these topics. And I'll hand right back to Ryan. Thanks so much, everyone.
Right, thank you. Oh, let me see when I'll get my video started. Come on. Technology's let me down again. Here we go. Right, and we're back. Yes, thanks, Sam, and thank you to everyone who took time out of their day to join us this afternoon. We hope you've come away from this session feeling more enlightened about these reforms, what you need to know going forward, considerations around software, what that could mean for your clients, and how you can be better prepared for the changes coming down the road. And James, we will get that question answered for you. That's a promise. And we hope to see you all again for our next webinar. I hope you all enjoy the rest of your day. Take care. Goodbye.